Hi, in this video, I want to talk about 5 rules on how to disperse small deposits in trading. I'll tell you about 5 rules that mathematically increase your chance of unwinding a small deposit. And this is especially true in the context of prop trading, in the context of competitive account development. These rules will help you improve your performance and pass the prop trading tests issued. So, let's not take too long. The first rule of account overclocking is to follow the rules of risk management. I realize this can be boring. All the videos talk about risk management, small trade size, risk and stop loss management, and so on. And in general, it seems intuitively that if the deposit is small, in order to disperse it, you need to make big bets and get some substantial profit as soon as possible. But in reality, the reality is that the lower your bet size, the longer term you will be able to use your strategy and make a profit. I think many of you have heard about the famous 2% rule, that the stop loss on each of your positions should be no more than 2% of your deposit. For example, if now on the balance, here on the test balance, for the challenge there is $5,000, then the loss on each individual trade should not be more than $100. For example, we want to enter a trade here at this point, in the stop loss. If we set it below the chart, you should set it so that even if the stop loss is triggered on this trade, so that your loss is not more than $100 per trade. Why is it mathematically wrong to put trade sizes at 20, at 50%, and so on? Because even if you have a good working strategy with an average performance of about 60% profitable trades, which is about the standard value, that means that 4 out of your 10 trades will be at a loss. And if you get a series of such bad trades, you can severely land your deposit. For example, if you have each trade size of 20% of your original balance, then 2-3 trades are enough for you to lose half of your balance. And I'll remind you that if you lost 50% of your balance, it's not 50, but 100% that you need to get back. Notionally, if you lose 50% of the $5,000 that's currently in your balance, that would be $2,500. Though just to rebuild your balance, you need to make 100% profit to just double that $2,500 in order to get back to just $5,000. And it is much more difficult to do this than to initially set a normal amount of risk and already starting from it to make more confident trades. Mathematically, we came up with a trade size that should be 2%. It's even worse when you put up 50%, for example. In this case, even 2 unsuccessful trades in a row, which will definitely be sooner or later, will be enough for you to completely lose your deposit. So the first rule is to follow the rules of risk management. The second rule is the use of compound interest. You don't have to constantly chase profits every day, every week, and so on. The longer you make profits over long stretches of time, the more your deposit will accelerate. It's like the snowball effect. When you launch, for example, a snowball down a slide, it's small at first, but as it rolls down the slide, snow piles up on top of it, and it gets bigger and bigger each time. And rather than getting a notional 100% profit in a week at high risk, you're better off getting 10% each week, but doing it consistently. And in that case, let's say if we start with $5,000 and we want to unwind that deposit, if we get 10% in the first week, that's already $5,500. The next week, we'll get the new 10%, not from $5,000, but from $5,500, and so on. This capital will increase, and let's say when we already reach the mark of $20,000, the weekly increase of 10% will give you a profit of $1,000, $2,000, and so on. And over time, even this small percentage profit will bring you tangible money in nominal terms. The next very important point is choosing the right strategy. And here I want to remind you that in technical analysis, in fundamental analysis, a complex strategy does not mean a good strategy. You can choose the simplest conditional strategy, let's say a moving average strategy. Let me show you just by example. If we choose a moving average strategy, We set a period of 200 so that it shows us the average value for 200 candles. Here it is lined up. And even if you use the trivial strategy that when the chart is above the 200-day moving average, you only enter up trades. By the time the chart is above the 200-day moving average, below the 200-day moving average, you will want to enter down trades. If you test even such a trivial, simple strategy and see that you get good results with it, you don't need to invent anything supernatural. You can just stick to it further in your deposit acceleration. It is important that the strategy suits you specifically, and you can confirm it for yourself on a demo account. The second important point is that the strategy should be clear and unambiguous for you, that it should give clear signals, and you should not try to guess whether it is a good trade or not. And in this case, if you provide at least 60 to 65% profitability on your strategy, you will be more likely to profit on the long-term distance. You will have positive math expectations. Next comes the next fourth rule, a very important one. Your risk to return ratio should be at least 1 to 1, and ideally more, ideally 2 to 1. What does it mean to have a risk-reward ratio? I mean, if let's say we want to go into this deal here. According to our strategy, now the chart is above the 200-day moving average. We want to enter the trade upwards. Then we will set the stop loss at approximately this value from the entry point. Let's say it is 100 pips. Our take profit, our target on this trade, should be at least the same, at least also 100 pips, and ideally twice as much. And in such a case, even if your strategy will give a roughly random 50-50 distribution of profits and losses, that is 50 trades plus 50 trades in the negative, if your profit to risk ratio is higher, you will still make money long term because you will gain more from a profitable trade than you will lose from a losing trade. This is the fourth important rule. We must have a return to risk ratio greater than 1. 1 or more than 1. That's how let's put it. And the fifth rule, a very important one, is to keep a diary of trades. You can simply keep a record of your transactions in a regular Excel file. That is, when did you open it? On what asset? On what time frame? At what time of day? What strategy did you use? Did the deal come out in the plus side or not? If the deal was in the plus, the line can be marked in green. If it was in the minus, then red. And over time, you'll definitely see trends. That is that on some particular asset, or on some particular time frame, or at some particular time, you make more positive trades than at other times, for example. And when you figure out for yourself these individual factors in which you trade with greater profitability, you can implement them into your daily strategy and greatly improve your results. These are the 5 rules that many people talk about, but almost no one follows them. These 5 rules will really help you to accelerate a small deposit to a large one and fulfill those challenges that are specified in the pro trading plans.